All right, last one. We already covered all the major number crunching in this chapter. Let's just talk some of the principles and how accounting principles and how they apply to inventory. So one of the things, the accounting principles, one of the requirements is consistency, right? Consistency, you do the same accounting treatment from period to period so that you can compare one set of financial statements to another. As far as how inventory goes, if you think about it, the idea is you can use any of the four inventory methods, but you have to be consistent, right? If you're going to use LIFO on one statement, you got to keep using LIFO. The thing is, though, you can actually change between methods. You can decide LIFO just doesn't make sense for you anymore and you want to switch to FIFO, and that's fine. You can do that, but you're going to have to do a lot of restatements of financial statements so that there's some comparability, some consistency. And of course, you'd have to detail, everything you did in the notes of the financial statements to let the end user, the person who's looking at the financial statements, understand why there's so many changes. It is a big deal to change between inventory methods. It wouldn't be something done lightly. But, just because you chose LIFO in the beginning doesn't mean you have to stick with that for all the time. All right. Disclosure. So, we have to put out all four financial statements. Of course we do. And in the notes of the financial statements, like I just said, you have to disclose any sort of change or any sort of anything related to inventory that would be important to someone. And that falls into the materiality concept as well. The materiality concept says, you have to report things that would make a regular user change their mind if it wasn't stated. So let's say you're off by a couple $100 on your inventory. Not a big deal. If you're off by a couple $1,000, again, maybe not a big deal. It all depends on the size of your company. If you have $1 million company and you're off by a few $1,000s in your inventory, not such a big deal. If you're off by like $100,000 inventory, kind of a big deal. That's material. That means significant items need to be reported. And the last thing, be conservative. Right? Always be conservative. You anticipate, and we haven't really talked about this at all, being conservative means you don't anticipate gains before they actually happen, before they're realized. But if you expect there to be a loss, and we'll get to this one in the liability chapter, but if you expect there to be a loss, you would actually record that loss even if it hasn't happened yet. It says, if in doubt, record an asset at the lowest amount. If you think about the historical cost principle, we always have to record the assets for what we originally purchased them for. Even if, let's say the prices are way higher for those assets now, still record them at the lower amount. The idea is that being conservative means you're always understating and always picking the lower numbers. Whatever makes you look worse, if that's that. I mean, that doesn't sound great, but you'd always pick the higher expense if you were trying to estimate between two different expenses. So, conservative. All right. So one of those things, and this is a segue into this, is the lower of cost or market when it comes to inventory. Inventory should be recorded at the lower of cost, right? The four methods, or the market. And market doesn't necessarily mean the price you're selling it for. It means how much could you get it for somewhere else. The replacement cost is really better, but they use the word market. So LCM stands for lower of cost or market. And it's a fundamental conservative accounting principle related to inventory. Okay, so what we're going to do is let me talk about why this is in place. This is in place to keep people from reporting inventory at way higher prices than what it actually could sell for. So let's say that I have a whole bunch of Sony Walkmans from the 90s. Or Discmans. Let's go right. Well, Walkmans. I have a whole bunch of Sony Walkmans, and maybe I had purchased them for $50 a piece at the time. Nobody's buying for $50 a piece. You can't even buy it like today, right? You can't even buy cassette tape for period. I don't even know if they even sell cassette tapes anymore any place. The idea is that maybe that Sony Walkman that I had originally purchased for $50 is now worth $2. But I purchased it for $50, so I should be able to record it on my books for $50, right? No, that's what this is here for. The idea is you're always going to say, well, the cost would have been $50 to me, but the market is $2, so I've got to record it at the lower amount, $2, and I'd have to write my inventory down. This is to prevent people from keeping inventory at too high a price, right? Overvaluing your inventory, if you will. So let's look at, so why would the market go down? Obsolescence, right? Obviously, a Sony Walkman is obsolete at this point. Permanent market conditions, maybe the market, something like Beanie Babies, right? That's nobody's buying Beanie Babies for $100, $200 a piece anymore, right? Market conditions are just not there for it anymore. Oops, too far. All right, so there's a couple of reasons why the market price would go down. I mean, there's really any number of reasons the market price would go down, but these are kind of the common ones. All right, so let's say you have scenario 1 and scenario 2 here. Let's say the cost, the amount that you're carrying the inventory for on your books is $50,000, but the market price for the same product, or the replacement cost for the same items is $60,000. Well, the idea is you're already carrying it at the lower cost. You're carrying it for $50,000, right? The lower of cost or market cost is lower in this scenario, so you wouldn't need an adjustment. Market price is higher, you're fine, right? The cost is what it's recorded for on your records. So now let's look at scenario 2. Your cost is $50,000, right? That's how much it's on your books for, your inventory. But the market's only paying $45,000 for these, not paying, but you could get the market price for these is $45,000. The replacement cost is $45,000. If that's the case, you're going to write off that inventory. You're going to bring it down because your inventory is not currently at the lower of cost or market. Market is lower, so we've got to bring it down. So the way we would do that, and here's kind of words around it, but the way we do that is, we would bring it down from $50,000 to $45,000. So we need to credit our inventory for $5,000. There's our credit to inventory, $5,000, and our debit is to cost of goods sold. It just is, because it is an expense of doing business. It is an expense of your inventory. So you're going to record it along with all the rest of the costs of the inventory that you're selling. Cost of the goods that I'm selling. That's cost of goods sold. Okay. So just a little illustration here. Johnson owned 100 DVD players purchased for $180 each. As a result of technological advances, the supplier has just reduced the cost to purchase the DVD players to $125 each. Johnson can sell the DVD players for $275. Okay, lower of cost or market. Well, there's our cost, $180. That's what we purchased it for. The market replacement cost is $125, so I can really buy more DVD players for $125. That means that the market price is lower than the cost. $275 is actually a sales price. I don't care about that. I don't care what I'm selling it to like the end person for. The question is, how much can I get another one for? Replacement cost, right? Market stands for replacement cost. So if that's the case, I need to bring it down to $125. I'm going to have to do that journal entry to bring it from $180 to $125. Okay, the next, too far. Johnson owns 50 CD players. Are purchased at $75 each. We've been selling them for $150. However, a new electronics store has just opened, sells them for $130. But my supplier, my replacement cost, is $75. That's to purchase the units. And the store has been forced to reduce its price to $130. Well, there's a lot of numbers in here. I don't care about the sales prices. Let's kill those. $150. I don't care about the $130 my competitor is selling for. I don't care about my new retail price. What I care about is how much I purchased them for, the market, the cost. I'm sorry, what I purchased them for, the cost. I was reading market above. $75. And what my replacement cost is. My replacement cost is still $75, the market replacement cost. I don't have to do anything. I'm still carrying it at the lower of cost or market. We're good. Okay, I hope that makes sense. Okay, a journal entry for that, just to show you how this works again. Claremont has the current, all right, so we're looking at inventory. I'm just going to pick this apart. You can pause it and read it. But you got inventory. It's got $13,500. But the replacement cost, the current market value, is $12,400. Well, guess what? That's the cost. That's the market value. I'm carrying it too high. I've got to bring it down. Right? Current replacement cost less the cost of inventory. I've got to bring it down by $1,100. So my journal entry is going to be debit to cost of goods sold, same as it was before, and a credit to merchandise inventory for $1,100. They said, what would the value report? What would they report it for as merchandise inventory? Well, now inventory would be reported at $12,400, the lower amount. Okay, oops. There you go. To kind of illustrate the journal entry there. Okay. All right, 9.5 minutes. What if there's a mistake? What if somebody miscounts? You know what? This is going to take more than a minute, so I'm going to pause it. Sorry, we're going to do one more.